It's an urgent warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the FDIC cautions all depositors that your deposits may no longer be safe. I'll show you what the FDIC is so concerned about and what they believe is a catalyst that could lead to a large number of bank failures. Now let's head over to Bloomberg, where we picked today's story up with a headline: as U.S. banks' paper losses on some securities has now increased and rather significantly, and this is a challenge for the banks who find themselves in a loss position not only on their securities portfolio but their loan book. And if anything was to set off a bank run or insolvencies in the banking industry, well, it would mean a large number of banks would fail. And U.S. banks' paper losses from two key types of securities they hold rose last quarter due to further stresses in the housing market. This according to the FDIC. And this is interesting because virtually nobody's talking about stresses in the U.S. housing market. There's been a focus on commercial real estate and how a lot of small and mid-sized regional banks hold a large number of those loans. But with real estate prices continuing to rise, it almost is somewhat baffling now that the FDIC is so concerned that something could be on the cusp of the next financial crisis. The FDIC said Wednesday that unrealized losses across the sector on available for sale and held to maturity securities increased by $39 billion to $517 billion in the first 3 months of 2024. It's the 9th straight quarter of unusually high unrealized losses since the Federal Reserve began raising interest rates. And these are losses that are sitting on the books of banks all over the United States at a time when we hear from the Federal Reserve that the banking system is solvent and strong and should be something that every depositor can rely on. But all of a sudden, the FDIC is saying this problem is only getting worse. And despite the increase in paper losses and the number of lenders included in the regulator's problem bank list, the FDIC said in its quarterly banking profile that the industry now remains solid. And this makes absolutely no sense. If the problem at the banks is getting worse with unrealized losses, then it would suggest that underneath the issues with the banks are getting actually far worse. But if they came out, and I want you to understand this, if the FDIC came out and said, look, these are banks that are on the verge of failure, you could only imagine it would trigger massive amounts of bank runs and lead to insolvencies. Much like the Federal Reserve, the FDIC is hoping that everything will somehow work out. And Martin Gruenberg, the head of the FDIC, said the net income rebounded and asset quality metrics remained generally favorable. He added that the industry's liquidity or amount of cash was stable, and we've noted that that's not the case at all. There's no stability here in the U.S. banking system at all. In fact, when the Federal Reserve tightens lending conditions, there isn't enough money in the system, which is going to force the Fed to cut in a major way, as we're going to see probably well before the end of the year. But the issue is now coming down to the housing market, and there's serious problems there. But one place there shouldn't be any problems, that is your trading account, because when you see headlines like this, as wheat hits now a 10-month high on worries over Black Sea crops, you should be looking at your trading account and saying, I'm making money because our subscribers are doing just that. Could you imagine what this would do to your brokerage account if you woke up and saw a trade that's up nearly 25%? That would be game changing, because we showed our subscribers to buy down here. And what did we do? How did we do that? Well, there's two ways we achieved this. One is we looked at the machine positioning and noted the machines were deep short positions. This is our CTA Time Pro report, and price was moving against them, forcing them to short cover, and that led to, of course, what you see here is a big return. How about our Momentum Time Pro report? This looks at the technicals, but we run a proprietary overlay over the signals to give you better entry points, and that is something we do every day. We give you the report, we give you videos on the trades, on how we think you should trade it, and we give you all the information to be a successful investor. And on top of that, we give you a 30-day free trial. Check those links out in the description below and you start making some big money trading. As seriously, underwater home mortgages now tick up across the U.S., and you can see underneath that FDIC report report where they say, well, there's plenty of liquidity. The problem is there's plenty of liquidity going into the global financial crisis, and now things are changing in a big way, as roughly 1 in 37 homes are now considered seriously underwater in the U.S., and that share is much higher across a swath of southern states. Something I'd like to know from you: do you believe the U.S. banking system is strong, as the FDIC and the Federal Reserve say, or do you believe that we're on the cusp of the next financial crisis? I'd love to know what you think. Weigh in the comments below. As nationally, 2.7% of homes carried loan balances at least 25% more than their market value in the first few months of the year. That's up from 2.6% in the previous quarter, and that is dangerous move. This is heading in the wrong direction. You know, we note that if we are going to achieve a soft landing or no landing scenario, again, love to know what you think about that. Then what we should see is banks' situation should be improving. Everything should be getting better, and what we're seeing is signs is getting much worse, as mortgages now can generally become seriously underwater when someone overpays for a home, or when it's purchased with a small down payment that doesn't provide a sufficient buffer if property falls in value. But what if we continue to hear that real estate only goes up until it doesn't? And during the pandemic, government stimulus and rising property prices were a huge boon to homeowners as government money flooded into the housing market. But higher interest rates meant to curb inflation may be finally help cooling the housing market. And this is dangerous news for the banks in a big way, because they're carrying some of these loans. They've sold off some of these loans. They're insuring some of those loans. Again, you remember back to the financial crisis, you're seeing all these signs happen again. And it comes back to banks tightening lending standards. It has nothing much to do with higher interest rates, because if the economy was booming here, then of course consumers could afford higher prices. That wouldn't be an issue if their wages were going up, if they're getting more hours. It would all make sense that they could afford these higher prices. But what's happening is we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. It's shown in blue, and anytime that blue line is above the horizontal black line, it means banks are tightening lending standards. And all that translates to is when somebody goes in to get a loan, whether they're a consumer or a business, it means the banks are more likely to say no, and that means less money is being created in the system to support not only the debt in the system, but achieve the economic growth targets the political elites want, and that does actually affect housing prices. Now, it did not back in the dot-com bubble, because, of course, what happened then is the boomers were driving a big housing demand, but look what happened in 2008 and 9. Of course, we saw home prices go down. If that happened again, well, it'd be a big risk for the banks, and now they're tightening, and is likely going to get tighter. And if at some point, if home prices reverse direction, watch out. It's already in a danger zone now. As U.S. mortgage rates rise for the first time in a month, and here's the key problem: denting demand. At any time you see a reduction in demand, that means interest rates in a debt-based economy are too high. Of course, don't tell that to the Federal Reserve. They're rather convinced they're going to keep rates up until the end of the year. We'll see about that. If the banking system goes, well, so too will the federal funds rate. As the contract rate on 30-year fixed mortgages increased 4 basis points to 7.05%, but that dragged down a gauge of refinancing by more than 13%. But here's the big one: purchasing activity fell to the lowest level in 3 months as we continue to see demand evaporate. And again, this is a problem, because at some point, if you don't have enough demand to buy homes, prices start to come down. It's so bad everyone from leading economists to the country's top leaders, including President Joe Biden and Treasury Secretary Janet Yellen, have bemoaned that the market is, quote, almost impossible for some home buyers to crack. Owning a home is a status symbol, but once a status symbol becomes so expensive, people start to reject it as being something that's worthy of striving for. Home ownership is becoming less of a middle-class dream and more of an aspirational dream that comes with above average wealth. What do you think? Is owning a home now a status symbol, much like going out to fast food is a luxury? I'd love to know. Weigh in the comments, as U.S. home prices have reached a new record high in March, despite soaring rates, as sellers look to get higher prices. Here we can see in America's 20 largest cities, Prices rose for the 13th straight month, according to S&P CoreLogic and Case-Shiller. That pushed prices up a whopping 7.38% year over year, the fastest increase since October of 2022. And we've witnessed records repeatedly break in both stock and housing markets over the past year, with the national index reaching new high in 6 of the last 12 months. The only question is, how much longer will that last? Because perhaps now owning a home is also going to be a luxury. But here's what you can see is going to make the change. As new one-family houses sold is shown in blue, you notice that there's a deceleration here, and I've overlaid all transaction home prices for the United States in red, that on a year-over-year rate of change. And what this suggests is that year-over-year rate of change increase in home prices is about to trend lower, because where new home prices sold, or new homes sold, go, this according to builders, well, home prices fall. Because remember, builders can discount far more than the resale market. But there's another factor here that could send, of course, the housing market spinning and, of course, bring the banks down, which is what the FDIC is warning, and that is the U.S. economy. As we turn to the 5th District survey of manufacturing activity, where they noted that activity remained sluggish for May this year in Richmond, the composite manufacturing index increased from -7 in April to 0 in May, meaning it's unchanged. But that is only the best part of this story, because the unbalanced firm continues to report declining backlogs and vendor lead times in May, as those indices decreased and remain negative. And one thing we've noted, that as backlogs go away in the manufacturing sector, if there's not enough new order growth to maintain the workforce, then what happens is hours start getting cut, and then when you start cutting enough hours, you start cutting heads. And of course, when you do enough of that, well, the real estate market stands no chance, and along with the banks. And the average growth rate of prices paid increased slightly in May, while the average growth rate of prices received decreased, meaning manufacturers are being forced to raise prices, but they're not getting it. That is an indication, my friends, that demand is weakening in a big way. Here you can see backlogs have been continuing to contract. At some point, these are going to run out, and when that does, well, so too is the U.S. economy. You can see number of employees starting to decrease here as they start to lay off. And notably, they don't cover hours worked in this report, that we can assume that hours worked are going down as well, because one of the problems here is prices paid are rising. Prices received are falling. Again, this is a supply and demand issue. We went from not enough supply and too much demand, now to too much supply and not enough demand. It's not just Richmond. As we now turn to Texas, where we get the services sector outlook, we see more damage coming, of course, to the employment sector. As growth resumes in Texas services sector, but outlooks continue to worsen. This is not a good sign, as labor market measures suggested a resumption of employment growth, but no improvement in work weeks. So they added a little bit. The unemployment, or the employment index, that is, jumped from -2.6 to 3.9, but the part-time employment index fell to -2.5, while hours worked increased 2 points to -0.4. Respondents may continue to perceive worsening, broadening business conditions, as the general business activity remained negative and fell 2 points to -12. Input prices continue to ease, and selling prices remain the same. But here's the problem: wage pressures increase slightly. You look at what's facing employers right now is they're seeing weaker demand. They're being forced to pay their employees more, and they're getting squeezed at the margin. This is not what they're looking for, and that's all going to lead to more hours getting cut, jobs getting cut. And when you start to look at new one-family homes sold, well, you need an economy that's strong enough to buy homes. And when you overlay continued unemployment claims, what you know is as continued unemployment claims move higher over time, what happens is new one-family homes sold, that number you see decreasing in a big way, suggesting the weakness in the housing market now has everything to do with the labor market. But it's going to get worse as we look at the Retail Outlook survey, which notes that in Texas, retail sales now have weakened even further. Retail sales activity declined in May, according to business executives. The key measure of state retail activity fell from -10.4 to -16.4. This is, again, indicating that demand is getting worse, and this is not a good sign for the economy at all, indicating retail sales fell at a faster rate than the previous month. Retail labor market indicators suggested a contraction in employment and work weeks in May, something we noted would happen. The employment index fell from minus 0.5 to minus 5.2, while the part-time index fell from 10 to minus 7, and the hours worked continued in negative territory to minus 4.2, as retailers are now finding out that they stocked up for the big demand boom, finding out that it isn't there at all. As retailers continue to perceive a worsening of broader business conditions in May, and the general business activity remained in negative territory and fell 11 points to minus 28.8, the lowest level since December of 2022. The outlook uncertainty index increased 6 points to 15.1, suggesting that things in Texas are getting worse, things in Richmond are getting worse. If you look at the housing market now, it could be the big shoe to drop that would bring the banks down. FDIC giving us a little bit of warning, because what happens when retail sales growth starts to slow or even worse contract, well, that means they're going to be laying off fast because they cannot afford to have people standing around. They'll cut hours, they'll cut employees, and here you can see as retail sales growth slows, what we know, unemployment figures head higher, which suggests that we're going to see an increase in continued unemployment claims and initial claims in the months to come. And we can look now at some details from the Texas report to suggest things there are only going to get worse. As we look at truck transportations, well, they say it's definitely in a recession. Warehouse and storage as well, we're seeing a little bit of slowdown. And publishing industries, well, check this out. Growth is declining and new business inquiries have waned for key products and services as high interest rates are starting to impact our customers and prospects. And look at this, when we take a look at commercial real estate, our ability to raise capital for new projects has been greatly impacted by current interest rates, and the value of existing assets, same problem the banks are facing, has been significantly impaired. Currently, all levers are in the wrong direction for our underwriting of existing and operating assets and future developments. Rents are softening. Overall capital and financing costs have substantially increased, suggesting problems there are only getting worse. But that is only the beginning, because here you can see this is the worst we've seen in the real estate market since the Great Recession. And mind you, no political elite is forecasting at all we could be on the cusp of the next financial crisis. We've been suggesting that due to the Fed tightening lending standards at the banking level, that it was only a foregone conclusion. And now the FDIC is warning, if the housing market goes, well, the banks, they're next. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.